Today we are diving into something every investor needs to get right. It's asset allocation. Yep, we are talking about how to determine that perfect mix of stocks, bonds, and other investments for your portfolio. Let's break it down. First up, risk tolerance. Ask yourself, how much risk can you handle? Are you comfortable riding out the market's ups and downs, or do you prefer stability? Knowing your risk tolerance is key to avoiding sleepless nights. To assess your risk tolerance, be sure to take a quick quiz at the end of this video. Next, think about your time horizon. How long do you plan to invest before you need the money? If you are young and have decades ahead, you can afford to take more risks for potentially higher returns. But if you are closer to retirement, you'll want to focus on preserving your capital. Then there's your financial goals. Are you saving for a down payment, your kids' college, or retirement? Each goal may require a different strategy. For example, saving for a house in 5 years might mean a more conservative approach, while retirement savings over 30 years could mean a more aggressive stance. Before we dive into asset allocation strategies, let's understand some terminologies we will use in this video. When we say equity, we refer to equity-based assets like stocks, equity mutual funds, exchange-traded funds, and REITs. It also includes preferred stocks, dividend stocks, employee stock ownership plans, and more. For details on equity assets, watch our in-depth video on investing in the description or I button. Debt investments include government bonds, corporate bonds, and fixed deposits. These also include treasury bonds, peer-to-peer lending, and post office savings schemes. For details on debt assets, watch our in-depth video on saving in the description or I button. Now, let's look at some asset allocation strategies. First, let's look at the rule of 100. Here's how it works. Subtract your age from 100 to determine the percentage of your portfolio to allocate to equities. The rest goes into debt and safer investments. Let's break it down with an example. If you're 30 years old, you should invest 70% in equities and 30% in debt. At 60, the suggestion shifts to 40% in equities and 60% in debt. Why use the rule of 100? Its simplicity makes it accessible, particularly for novice investors. It follows the principle that younger investors can embrace more risk, while older investors should lean towards stability. But remember, like any rule, it has its limitations. The rule of 100s can oversimplify. It doesn't account for individual risk tolerance, personal financial goals, or specific circumstances like life expectancy and market conditions. In conclusion, the rule of 100 offers a great starting point for understanding asset allocation. If you don't like constantly tweaking your investments but still want solid returns, then this strategy is for you. Constant weighting asset allocation is a simple yet effective investment strategy. Here's how it works. You set a fixed percentage for each asset class in your portfolio, like 70% equity, 20% international stocks, and 10% bonds. As markets move, those percentages will shift. To keep your original balance, you rebalance by selling some of what's grown and buying more of what's lagging. Why consider it? First, it's simple and easy to manage. Second, regular rebalancing keeps you disciplined, avoiding emotional decisions. Third, it focuses on long-term goals, helping you ride out short-term market swings. And finally, it aims for steady returns by buying low and selling high. But beware, it doesn't adapt to changing markets and can rack up transaction costs. For long-term investors who want a straightforward approach, constant weighting is a solid choice. Remember, rebalancing when deviations exceed 5% can help manage costs and tax implications. Simple, steady, and smart, that's constant weighting asset allocation. Ready to give it a try? Next up is strategic asset allocation, or SAA. SAA is a long-term investment strategy that involves setting and maintaining a target mix of asset classes, for example, stocks, bonds, real estate, gold, and cash. It is based on an investor's financial goals, risk tolerance, and time horizon. Imagine setting a target mix for your investment like stock, bonds, gold, and cash. For instance, 60% stocks, 20% bonds, 10% gold, and 10% cash. then periodically tweaking it to stay on track. The strategy is not about timing the market, but ensuring that the portfolio aligns with long-term objectives. SAA is for those who can commit for 5 years and more. Now, rebalancing sounds fancy, but it's just adjusting back to your target mix when markets shift. For example, if stock prices rise, the portfolio may become 70% stocks instead of 60%. Rebalancing ensures the portfolio returns to its original allocation by selling overperforming assets and buying underperforming ones. Managing risk is key. By controlling how much you invest in each asset type, SAA helps keep your risk in check and your goals in sight. You can sleep better at night. Strategic asset allocation is ideal for disciplined investors who want a structured approach to building wealth over time. While it requires periodic reviews and adjustments, this strategy is not as actively managed as other approaches like tactical asset allocation. SAA could be the map you need for a smoother investment journey. Tactical asset allocation is an active investment strategy designed for those ready to seize short-term market opportunities. This strategy involves adjusting your portfolio's asset allocation in response to short-term market conditions, aiming to capitalize on inefficiencies or trends. For example, if an investor believes stocks will outperform bonds due to strong economic data, they may temporarily allocate more funds to equities. Once the outlook changes, they can revert to their original or a new allocation. However, this strategy comes with higher transaction costs and taxes. Tactical asset allocation is ideal for seasoned investors who can spot opportunities across different asset classes. It's also suitable for high-risk investors who can handle short-term market volatility in pursuit of gains. And for those with the time and tools to stay updated on economic trends and news. Tactical asset allocation deviates from the fixed long-term asset allocation to maximize returns in the short term. Your perfect asset allocation depends on your unique situation. There's no one-size-fits-all strategy. Take the time to assess your risk tolerance, time horizon, and financial goals. And if you are unsure, consulting with a financial advisor can provide personalized guidance. Here's a short quiz to assess risk tolerance. First one, how long do you plan to keep this investment before you might need to withdraw money? Give yourself 1 point for option A, 3 points for option B, and 5 points for option C. Next, if your investments drop 20% in a few months, what would you likely do? Give yourself 1 point for option A, 3 points for option B, and 5 points for option C. Next, how stable is your income and financial situation? Give yourself 1 point for option A, 3 points for option B, and 5 points for option C. How do you feel about high-risk, high-reward investments? Give yourself 1 point for option A, 3 points for option B, and 5 points for option C. Next, what annual return are you aiming for in your investments? Give yourself 1 point for option A, 3 points for option B, and 5 points for option C. Last one, how would you rate your knowledge and experience with investing? Give yourself 1 point for option A, 3 points for option B, and 5 points for option C. Here's the interpretation of your scores. 6 to 11 points. You're most likely conservative. You have a low risk tolerance and prefer stable, lower risk investments with more predictable returns. 12 to 19 points. You most likely have moderate risk tolerance. You have a balanced approach, willing to take some risk for moderate returns. 20 to 30 points. You are most likely aggressive. You have a high risk tolerance and are comfortable with volatility for the potential of higher returns. This quiz can give you an idea of your risk tolerance, but Remember to revisit it over time as your financial goals and situation change. Here are some examples of asset allocation. Conservative allocation. Focused on preserving capital and minimizing volatility. Suitable for individuals who prioritize stability and consistent income over growth. Ideal for retirees or those nearing retirement, and investors saving for short-term goals. Balanced allocation. Balances growth and stability by mixing equities and fixed income. Suitable for individuals who want moderate growth but are cautious about excessive risk. Ideal for mid-career professionals with medium-term goals and investors with a mix of growth and income needs. Growth allocation. Prioritizes maximizing returns with less concern for short-term market volatility. Suitable for long-term investors who can endure market fluctuations. Ideal for young professionals with decades before retirement and investors focusing on wealth accumulation. Aggressive allocation. Allocates the majority of the portfolio to high-growth assets with minimal exposure to debt or cash. Suitable for investors who are confident about handling significant volatility. It's ideal for experienced investors with a high-risk appetite and individuals investing for very long-term goals, for example retirement, in 30-plus years. Income-oriented allocation. Focuses on generating steady income through dividends or interest payments. It's ideal for retirees looking for passive income streams and individuals with a low tolerance for risk but seeking moderate returns. All-weather allocation. Aims to perform well under various market conditions by diversifying broadly. It's ideal for risk-averse investors who want consistent returns and those seeking to hedge against economic uncertainties. It's best to customize this further based on your life circumstances, like approaching a milestone. Choose an allocation that helps you stay invested during market downturns without panic selling. That's it for now. If you found this helpful, hit that like button and don't forget to subscribe for more investing knowledge. Happy investing!